Welcome to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner, and I'm here with Brian Regan, our firm's chief investment officer. And we both are at Asset Management Resources. We're a registered investment advisor firm, and happy to have you listening to our show, Something More with Chris Boyd. Our show is a financial show, but we call it Something More so we can talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. This time around, though, talking about money matters. And so, Brian, always good to have you with me to talk about some of these things. And you had an article drafted that we haven't even sent out, but I thought great topic for us to talk about on the radio. So I appreciate you taking the time to do that. And you have kind of a guide for smarter investing, essentially, a little bit of an outline that we'll talk about. And one of the things that I thought I happened to see that kind of dovetails with this was the idea of an article I saw in Morningstar questioning how much money do you need to be happy? And maybe I will come back to that at some point in time, but that kind of fits very much in line with some of the ideas you were talking about in this. Where should we begin on this inside out concept?
Yeah, so sometimes when I write, I know exactly what I want to write about, and sometimes when I write, I have a series of probably good tweets in my head that I don't know how to draft into a longer article.
Current article? Yeah. Yeah.
So what I do when I do that case is I just kind of write down all the tweets in my head and see if there's a theme here that makes sense. And the theme that I think I found when I did this was, how could I write this to simplify, a comprehensive guide to how people should think about investing? And I called it the inside out. A lot of times when we talk on the radio show or with our clients, the advisors are very, very good at getting to know the person, getting to know them emotionally, getting to know what their goals and their dreams are. And then a lot of the times I throw cold water on that with some more logical thinking, right? But they're both important parts of the process, and I call it the inside out because I think at the core you need to start with that inside, that emotional piece, what's important to you. But then you kind of need to leave it there, right? Once you set that goal-based process, once you think about the risk profile that's comfortable with you, then you start moving out into the more logical zone. And I thought of this as kind of concentric circles where the inside, was the emotional part. And, that determines a lot of the...
So it might inform the way you think about risk, as an example, but not define the actions you take every time.
Well, I think about it this way, right? So from the inside, the risk is that you don't reach your goals, right? As you move out, your risks get more detailed. They're a little bit different, right? So on the furthest out part of the inside out, I have identifying good value in cyclical stocks, right? That could not be more different than what is enough money for you to live a happy life. That's a completely different conversation. But if you don't start with what's the enough, there's no point in jumping to that last stage on identifying difficult to value stocks. And oftentimes I think, especially retail investors, they jump to that last part, which is the most difficult part. They miss the 7 steps prior. And then they get frustrated, where if they start with this comprehensive guide, I think that what they'll learn is to be a good investor, you don't even need to master, all the steps. Maybe just the first 3 or 4, and you could be perfectly happy. And sometimes you just don't even need to bother going to that last step.
Well, let's talk about that idea of how much is enough. What's going to be the enough to make you happy kind of thing. I think that's a really good insight. We get asked that oftentimes, what's my number? And of course, it's hard to define because it's a moving target.
I think it's personal too.
Well, it's definitely personal because of your own expenses, your own income, your own resources, all the above.
But you're all dreams and desires too, right? I think some people are happy living a more simple life, and some people, aspire for much, much more.
Yeah, in terms of like how the expenses that go with whatever that more might
Right.
be.
Right.
Uh, so that's true, and getting a handle on those particulars so that you can try to define it, put a number to it. The thing I was really driving at is that um, it it's hard to put a number to because it's a changing dynamic. Inflation will change. Your when I need it on this date. No, wait, I need it on that date. When on the continuum you want that to be your number can affect what is the number, right? So there's a lot of moving parts, but I think starting with that's essentially a financial plan that we're talking about that
Mhm.
you can kind of get a handle on. What do I need? How much? What's going
Yeah.
to take to get there? And then maybe some of that is also connected to risk. But you had a really interesting point as you were elaborating in the article, and that was, if you get to your number, whatever that number is, maybe that affects the way you think about how tolerant of volatility you either need to be or want to be. Um, it's
Well, you don't
funny,
need you don't need to be if you're there, right? I
right?
mean, I tell people that you don't need to get rich twice. I mean, if you already have everything that you've ever wanted, why risk losing that? That's the
Yeah.
spot you want to get to. That's what you've been working towards your whole life.
We have other
No
people,
reason to
Brian,
get
who will
crazy.
say, once I have that number, everything above that, I can take a ton of risk. Like I don't mind taking risk with that. As long as they've got
Well, I
their
guess anything marginally above, I get, I
yeah,
understand that logic, right? But take
yeah.
the chips off the table once you've won the game, right?
That's what most people think in
Yeah.
terms of though. They want to scale back the risk so that they don't lose it.
Well, I
Yeah.
do think there's a lot of people out there that just want to stack their chips as high as possible. And I think that's a mistake. I think that makes it
Yeah.
really difficult to be really happy. And I
Well,
think if you start and you sit back and you say, what do I really want out of this life? Can't bring the money with me. What do I need to be happy? And I think
yeah.
it's different for everybody else. Some people really want to travel a lot. Some people, want to retire at the age of 40. So, it's
Yeah.
just different.
They
It's
want
just
a
different for.
house somewhere else, they want their geographical changes. They want to do a cross country trip, whatever it is, right? These live in a Winnebago. I was talking with someone the other day. They wanted to sell the house, buy a Winnebago, and just travel the country for a couple of years.
Yeah, I
Uh,
mean, what's important to me is, being able to spend some time with my children and being able to send them to college. That's personal to me. When I reach the goal of sending them to college, I'm going to feel like I'm almost done. Right? I mean,
yeah,
I've
yeah,
accomplished one of my main goals. That's where I'm at. That's the enough for me. Right?
yeah. And no
I
doubt,
need
when you get there, you'll probably say, "Well, what are my new goals? What do I want to do now? And that might change. These things can evolve."
There'll be much cheaper goals though.
Yeah, right.
So my point is I won't have to be as aggressive with my investments. Maybe my risk profile will shift down.
Yeah,
Where right now I'm probably taking, relative to the average client, much more risk, right? Personally. And that's by design. I expect to be a long-term investor. And that's like the step two, right? Once you've figured out what's important to you and you've done the financial plan, which is helpful to get the details down, well, then you need to get an allocation that's comfortable so you can, stick with something for the long term.
we
And
often talk about buckets as part of that process, and that's just sort of mental games to help people say, "All right, this is our game plan, but we can stick to it if we've got sort of this uh, mix of places to look for different parts of the process. So here's some stability over here. We got some volatility over there, but that's intentional, that kind of thing. But ultimately, what's the allocation?
well, let's see. I think the most important thing is what's the allocation you could stick with for a really long time. And I don't mean 6 months. I don't mean 1 year. I mean until you have another life event that would require you to change, right? So another life event might be your children going to college. It might be you retiring. It might be you know, death of a spouse, something like that. But these are big life events. The best way to do well is to find the amount of volatility that you're comfortable with. And I think from personal experience that the average person is not comfortable with 100% stock risk. So there's probably going to be some other diversifying assets in there, primarily bonds, maybe some cash, to the bucket approach that you're talking about.
Yeah.
And that's all designed so you can stick with it for the long term. I know we say long term, long term, long term, and that sometimes that can be frustrating to people in the short term. But that's really the name of the game. You need to be able to set an allocation that you can stick with for decades to come.
Yeah, just to elaborate on that a little bit, and that is, we see this routinely that people at certain moments in time think they have a tolerance for risk until they have a significant decline in the markets, and their tolerance for risk changes. And what we want you to be in a position where, that's the worst time to be selling to reduce your risk. Ideally, what we want is a mix that you can tolerate that decline and stay with it, stay the course. Because if you do, things turn out much better. I think you had an example of something along those lines in your article, the idea of when markets declined, but if you were in it a year later, it was dramatically different.
Yeah, so I wrote an article, I think it was on March 14th of 2020, 2022. And it was addressing how, forgive me, I don't have it in front of me, but it was addressing how the stock market is not doing well right now. But in the long term, if you stick it out, I think you'll be happy, and I'll be sitting here being patient with you. And then, since I wrote the article, I think that first draft I did was on August 9th. That same portfolio, I think it was a 60/40 portfolio, was up something north of 10% from that moment. So it was true. If you just had some patience, it worked out for you since that date. And those are two arbitrary dates, but I can, there's mountains and mountains.
Numerous other examples of similar kinds of circumstance, right?
Right.
At the times when things are down, it's hard to be tolerant and ride it out. And of course, people want to be tactical, where they say, "Well, let me sidestep some of this decline."
Well, I think sometimes we hear is when the market's going down, people say, I don't have the long term. I'm 75, I'm 80, I'm 90 years old. I have a terminal disease. Well, not to be, I don't know what the word is, but not to be insensitive, but you're probably not investing for yourself at that point. If you have $1 million portfolio and you have a terminal disease, good luck spending all that by the time the check is due. What you're doing at that point is investing for your heirs. You're investing for your philanthropic ventures.
Yeah, there are other retirees though that do run the risk of spending by selling when things are down to meet their cash flow demands, and have adverse implications that could be worrisome. To run out of resources ultimately.
Yes, there is a situation where people don't have enough money to fund their lifestyle, and that's concerning. I think that's a separate topic, but
Yeah, and
very valid.
the broader picture is you have to make sure you have the right allocation before you have these kind of declines, so that if you can't withstand to withdraw on a schedule when things are down, then maybe we should scale back the risk.
Right. So, but the story is, the point is that you probably have a longer time horizon than you think or you realize. And almost 9 out of 10 people that I talk to that get concerned in the short term have a much longer time horizon than they realize. The next point I want to get into is know your investments. There's so many different kinds of investments, right? There's different kinds of stocks, from steel companies to social media companies. They could not be more different. There is an untold different amount of debt instruments, from sovereign debt, treasury securities, to asset-backed securities on autos and credit cards. It's just an untold amount. But what I think is really important for the average person is make sure that you're comfortable and you understand what you're investing. If you're buying an individual stock, make sure you understand the company. I remember one time, Chris, we had a gentleman in our office, and he says, why shouldn't I just invest in real estate? I understand real estate. It's been good to me.
Yeah.
I thought that was actually, maybe you should be doing what you're more comfortable with. I think in the long term, that's a really good thing for people. And I use the example of Enron, which was a famous fraud that I think many people probably over the age of 30 remember well. It was a fraud, and people had their whole net worths in it. And if you understood the company, at the very least, I think you might have been diversified away from that organization.
Let's talk about a couple of those items. So first off, the person who's entirely in real estate, we've seen a lot of people grow their wealth by owning real estate, but it is an equity, it is a risk asset, it is illiquid. There's a lot of things to be mindful of that create challenges. And so, ordinarily we would encourage people to be diversified as well, as part of how they deal with that. I follow your point though, that, you want to invest in things you understand. To dig into that, though, I think part of the challenge is people don't know what they don't know. So when it comes to, I understand, well, the investor in Enron says, I understand utilities are investments that historically widows and orphans use. It's an investment, utilities that people are always going to need. I can invest. Oh, look at the great returns I'm getting, and I'm in a conservative investment. When you talk about understanding an investment, you might be thinking about it in a different way than the layperson who is not necessarily an analyst, a chartered financial analyst, as are you. What that means, how you understand an investment may be slightly different from how the typical consumer, the typical investor interprets what they understand to be understanding an investment. How does one grow in that sense of an ability to evaluate and analyze a company's books and its profitability and its future prospects, uh, without necessarily just being reliant upon a subscription service or somebody else's point of view as it relates to this?
Yeah, I mean, I would say you need to hire a professional if you're going to invest in individual stocks like that, because it's a very difficult thing to do. It's a very difficult thing for professionals to do. But the good news is there are very easily understood, low cost instruments like index funds and ETFs, like
Provide.
money market funds that
Yeah.
are available to anybody to buy. And that's why I was saying you don't necessarily need all the tools in the tool belt to do well. If you just you know get your emotional side in check, if you build a portfolio that you can stick with for the long term, if you buy investments that you understand so that you'll be able to hold them during difficult times, you're well on your way to doing much better than the average person.
Um, and paying attention to cost in that process is part of the there's so many great offerings that are existing in the world today, when it comes to investing, that are broad, diversified, or even very narrow, diversified, offerings that one could maybe look to as a way to get their investments structured. Again, having the right help can be useful, but there's lots of opportunities that exist today that can be very efficient and cost effective. You also talked about the idea of getting a good deal. Uh, what did you mean by that?
Yeah, so this is kind of the next step, right? If you have the emotional side checked, if you've got the right asset allocation that you can stick with for the long term, if you understand the investments you're in, well, if you truly understand them, you might understand if the price is lower than the value that you're getting. And one of the things that I get into in the article is, every finance student, every MBA student is learning about how to discount investments at the same rate so they can understand why a stock is priced where it is. And what I'm saying is, hey, look, there's absolutely no reason why you can't demand an outsized return. You will have less assets in your portfolio, but if you understand your assets and you diversify your assets, you might have a a smaller portfolio of assets that have a very good opportunity of providing outsized returns. So, this is obviously, when we're starting to get into the next level kind of thing, we're really far from the emotional part here. We are putting
And this is also
numbers.
very different from saying about an index fund. Now you're saying if you're really getting into the weeds of picking your investments, there may be ways to look for investments that have greater potential. And that may be different from what some people's view of an efficient market would provide.
Yeah, this is doing the extra work, right? This is saying the market isn't efficient. I quote Warren Buffett, where he calls Mr. Market as a drunken psycho, where sometimes he gets enthused and sometimes he gets depressed. And I think that's true at some point in the market, not often at all the times in the market's totality, but sometimes in the underlying spaces. So, very, very occasionally you can find times in indexes where the prices are way out of whack with the value. But you're right. Oftentimes you need to be looking for, more specific types of assets, like more specific credits if you're doing fixed income, or individual stocks if you're looking for equities. But
This
my
may be a
point is,
subject for a longer conversation at some point in the future, but in a summary kind of overview, how do you identify those companies that have that greater potential?
well, that's a very difficult thing, and I think that gets to the last 2 points of my guide. It's very difficult to predict cash flows of companies, right? And ultimately, I say all the time that uh, stock prices are a function of earnings and interest rates. So in the part that I was just talking about, I'm more talking about the interest rate. The interest rate that you demand, the return that you demand, can be much higher than the market, and that's fine. That you're going to have a smaller portfolio. But you also need to, when you're evaluating stock, you need to be able to predict the cash flows to some relative, minor degree of error. That is a very, very difficult to do because you're predicting the future of an organization. It's impossible to do if you don't know the investment, right? So that goes back to knowing your investment. And when you predict these cash flows, it's typically over a long time period, 4 or 5 years, and then you do something called the terminal value. But my point is, to do it well, what you really want to do is find stocks that are very consistent, right? You want good management teams. I use an allegory to dating in this case, right? You want to, when you start seeing somebody, you want to be consistently dressed well, smell nice, and have a good personality. Well, similar to stocks, right? You want that to show up in the second date and the third date, right? You can't just like fall off. If I stop showering, I don't think my wife would be very enthused. This is the same thing that you need to do with stocks too. They need to be predictable. You need to be sure that year after year they're going to be able to deliver on the basics that you expect from them, and that makes it easier to predict their cash flows over a long time frame. So, I think you guys might often hear me say that I like consistency, I like persistence, and I like stocks that continue to grow. And that's what we're looking for. If it's not consistent, it just makes it for a much more difficult valuation. It doesn't mean it's impossible. It just means
Might
it's much.
start to stink, though. Yeah,
What's that?
might start to stink, though.
Well, oftentimes it will stink, right? So that's the last part, right? I call this part "stay cool, don't follow the crowd." Um, Oil and gas is a very cyclical industry, and I have a chart here that compares the stock of Chevron to the price of West Texas Intermediate crude. And the price of Chevron tanked when crude was negative. Well, you should ask yourself, was it reasonable that crude was going to be at negative for very long? Probably not, right? And will Chevron be able to survive as a business until the rates of oil and gas recover to normal times? Probably, right? So the time to buy that stock was when it was most hated, when the past cash flows looked horrific, really, right? Or the expectation in the
Yeah.
short term was horrific. But that's when everybody was wanting to sell them. So you got to kind of completely flip the way you think when it comes to cyclical type stocks or stocks that get really hot. When they're really high relative to the underlying cyclical commodity, you might want to think about making a change. And when they're really depressed, you might want to think about buying them. This is very, very difficult to do emotionally, and that's why it's the last part. It's the furthest part away from your politics, your family, your whatever it is. If you're going to invest in cyclical stocks, you need to have a really sober, logical mind. And it's not just cyclical stocks, but it's really any stock that is difficult to predict for the long term, right? So technology stocks often fall in this bucket. You can have a stock that comes shooting out of the gate, does really, really, really well, and then a bunch of competition comes in because they've identified a niche in the market. Maybe the software is not too difficult to replicate. Maybe a larger player can distribute the software better, and the forward returns get much worse. And this happens a lot. How many times have we seen tech stocks have an IPO, go up 100% and then fall 95% over the following year? This is very common. It can happen with automobile stocks. Yeah, I think you see it a lot as well recently. So that's the most difficult part of investing. If you get to the point where you can pick investments that are consistent, persistent, and growing, that are predictable, and buying them at a nice price, you're going to outperform, not just the average investor, but probably the market. If you do this last part, you're going to start hitting home runs.
Great stuff, Brian. Thanks for sharing this with us. I think we're going to need to put this into some kind of a little brochure as well, not just an article. But looking forward to having this published. We'll make sure our listeners know where to find it once it's out there. And we'll make sure it's available on our website, amrfinancial.com. With that in mind, thank you to our listeners for being with us. If you are listening and thinking, yeah, I really think I need to add a level of enhanced scrutiny and insight into my portfolio, you are welcome to reach out to our firm and see if we might be a good fit for your needs. We do like to address our portfolios in the context of your financial plan, as it very much makes sense in the context of this discussion as well. So hopefully we can be a resource to you in thinking about, how to structure things when it comes to your right risk profile, your overall planning needs, and then what is the right mix of investments and the way to go about it. Brian has ongoing commentary throughout our team. We do have things on our website about Brian's investor insights, as well as our quarterly economic and market outlook that Brian leads each quarter. So if you'd like to check any of that out, you can find us at amrfinancial.com. Brian, thanks for sharing your time and your insights.
Happy to do it, Chris.
Okay, until next time, keep striving for something more.
Okay, ready?
Ready.